Mark Bogar. The ECB is just starting out with its quantitative easing policy. The euro is collapsing. So tell me, are you bullish, you bearish on Europe right now?
We're bullish on Europe. As we've seen in the United States, when they started their quantitative easing program, that was the key signal for the rally in the stock markets. The Fed provided liquidity, it provided confidence, and that really set the stage, in my belief, for the rally in the U.S. market over the last 6 years. So what does that mean for Europe going forward? That means the ECB has really put their foot down and say, this is it. We're going to have liquidity. We're going to stand behind the continent. And I think it really does set the stage for confidence. That helps the banks. That helps dividend-paying stocks. But also does weaken the euro. So the euro has been weak, but that's very bullish for Europe exporters. Europe is a big exporting continent. Think about German industrials, German auto companies. It's very positive to have a weaker currency. The positive US dollar translates back to more euros, which is very positive for European exporting stocks.
I also think about the Germans bankrolling the Greeks. Will Greece stay in the Union? And if they leave, will Portugal and then Italy be next? How's that going to play out? Is there a fundamentally sound Europe right now?
Well, I think it actually is fundamentally sound. I think this question 3 years ago was more worrisome. So I do believe Greece will stay. I think they need the money that the European region provides more than they want to be on their own. But let's say they do leave. If they left 3 years ago, I think there was a contagion risk that would go to Portugal, would go to Italy, would go to Spain. But I think those countries have relatively fixed their balance sheets. You're actually seeing unemployment come down in Spain, say. Things are getting better there. And Greece is relatively small. So if it exits, it's not going to have the impact that it would have had 3 years ago.
Meanwhile, over in Japan, it's 120 yen per dollar. It's having a hard time weakening even further because it's hit up against that 120 mark quite a bit. So tell me, if it gets to 125, 130, will that make Japan more attractive?
I think actually Japan is attractive just from that standpoint of they actually have a phrase that's their last chance. They know they have issues. Their population is aging. They need to take a shot. And quantitative easing is one of the arrows they're using to take that shot. And so I do believe that the yen could weaken a little bit more, but that also means you can play the exporters just like you can in Europe. You can buy the auto companies, the tech companies, the industrial companies. Those are very attractive areas of the market to us, and they would benefit from the weaker yen.
Let's go to the emerging markets now. China is slowing. For a while, China was the driver of places like Brazil because they would suck up those raw materials. What's your view on China now, and can China lift the rest of the emerging markets?
I think it could be difficult for China to lift the rest of the emerging markets because, as you've said, they've built out over the last 5-10 years, built that infrastructure up, and they need to transition to that consumer economy. So as that slows, it's harder to pull everyone else along with them. India is a potential market that they can drive their own destiny, and actually with lower commodity costs, both in oil and iron ore, they can actually do much better. But China, it's going to be tough. It's going to have to manage a slowdown. It's going to be more difficult than it's been over the last 10 years.
And then finally, if you had to rank win, place, show, I guess the Kentucky Derby is coming up fairly soon, how would you rank Europe, Japan, emerging markets?
I would actually just, in the order you listed, win, place, show. So Europe first. I think they're farther along in the restructuring, farther along in the growth. You're seeing positive economic data coming out of Germany, out of Spain. So Europe's first. Japan's next. It's a big consumer economy. Lower oil prices benefits Japan. And then the emerging markets sadly pull up in last places. They're just managing the slowdown in growth. It's going to be tougher.
Win, place, show. Thanks for coming on.
Thanks for having me. Appreciate it.
And thank you for watching The Street.